What I want to talk about today is around personal deductible contributions in the superannuation. My name's Aaron from EK Financial Group, and as you can see, it is footy season. These are hopefully in the finals, prelim next week. So let's see how we go, but pretty excited. Anyway, back to claiming contributions in your super. So if you've made a personal contribution from your own bank account to your super fund last financial year, well, probably now's the time that you want to actually put in a notice of intent to your superannuation fund if your intention is to claim that contribution. There's a few rules around this. So effectively what happens is if you put money in from your bank account, you are now allowed to claim that as a personal tax deduction. Now, when you do claim it, that money then does fall under the normal concessional cap limit. So you got to be careful that you're not already at the cap before you do this. So those caps for last financial year, which was 2021, were $25,000. That was the contributions that your employer paid in on your behalf, so salary sacrifice or your 9.5%. Next financial year, or this financial year we're in at the moment, 2022, is $27,500. So the cap has gone up slightly. So back to claiming. So when you want to claim, what you need to do is you need to send a notice of intent to your super fund to let them know that you have an intention to claim that personal contribution that you put in. Once that is done, they then deduct the 15% contribution tax, give it to the ATO, but then they'll send you a confirmation letter, which you can then give to your accountant or use yourself when you do your tax return to claim it as a personal tax deduction. Now, there's four main rules around this and when you need to do this by. So the first rule is around you have to do this before you actually do your tax return for that financial year. That's number one. The second thing is you need to do it before 30 June of the next financial year. So you need to do it before 30 June 2022 if it's for the 2021 tax return and before you've done your tax return itself. Third thing, you need to try and do it or look at doing this before your super fund may pay a rollover, whether that be to an insurance company to pay for your insurance. Because if it does do that rollover, it reduces your ability to claim the full amount. And the final thing is you want to do it before setting up a pension fund. Okay, so they're the four main reasons when you want to be doing this. You can also vary a notice of intent. So if you've put it in, it was wrong, you can do a variation to that. Same as if you did that notice of intent during the financial year to claim that money before your rollover, maybe to pay your insurance premiums. You can then actually add more money in later as a personal contribution and claim again, as long as you put it in within the actual financial year. So you can vary it from time to time if you need to as well. It can be a complex area, a lot of minefields to think about. So it's best you do get advice from this. So speak to your professional, your accountant, your financial planner, and make sure you do it properly. That's my message for today. So it is kind of tax time. So you want to be looking at getting this done as soon as you can and before you do tax returns. Thanks, guys. See you later. Bye.